So you want to get away from the stock market? Here are 8 ways to invest without putting money into the stock market. Hello, my name is Shakaama. Here are 8 possible investment alternatives that can help you achieve your financial goals. Number 1, real estate. For many years, real estate was one of the most popular alternatives to investors who were skittish about the stock market. Unfortunately, it was also an investment that anyone who had watched home flipping shows on HGTV thought they understood, including me. Of course, we all know what happened in 2008, and 6 years later, many investors are still wary of the real estate market. But in many markets, prices still haven't entirely recovered from the crash, which means it's possible for average investors to add real estate to their portfolios. In general, there are 4 accessible routes to real estate investment. First is purchasing a rental property as an individual, and secondly, buying in shares in a real estate investment trust, REIT. Individually buying a rental property is pretty straightforward, but because you will have to invest money in upkeep and time into being a landlord, it's not necessarily everyone's cup of tea. Unless you use a management company which will cut into your profits, you may find that being a landlord takes up too much of your time and resources. A real estate investment trust, on the other hand, offers a less hands-on method of getting into the real estate market. A REIT works similarly to a mutual fund, except the investment is in real estate. Basically, the REIT is a group that invests in real estate properties and allows investors to purchase shares of the REIT. These trusts receive tax benefits in exchange for paying most of their income to the shareholders. Investors can purchase shares of REITs on public exchanges, which means that the investment is pretty liquid. In addition, shares of REITs pay out regular dividends. Brandon Turner of Bigger Pockets has been investing in real estate since he was 21. Here's what he had to offer the topic of real estate investing. There are 2 other popular methods of real estate that anyone can consider. Number 1, notes. You can actually invest in paper notes, second mortgages, etc. You can buy and sell notes just like real estate, and there are note brokers who handle this stuff. Number 2, crowdfunding portals. Recently, with changing legislation, there has been a rush of new portals that allow individuals, primarily accredited investors, to join together through the web to fund real estate deals. Sites like Realty Mogul and Fundrise are leading the way in this exploding niche. Keep in mind that rental property investing is not for the faint of heart. Unlike stocks or mutual funds, where you can simply rely on your broker to suggest and buy quote-unquote winners, real estate investors generally take some active involvement on the part of the investor. This doesn't mean you need to spend your weekends and evenings fixing toilets and taking calls from tenants, but it does mean you need to do some research on how to calculate real estate returns, spend time discovering the basic local markets to invest in, interview and hold accountable the best property managers to manage your tenants, and run your business like a business. This can be done with as little as a few hours a month, but it still does take some active involvement for the best returns. If you decide to invest in real estate, make sure you do your homework. Talk to experts like realtors, real estate investors, and your financial advisor. Real estate seems like a simple investment, but there's a lot that you might not consider. Just ask some home flipper who took a bath in 2008. Number 2, arts, antiques, and collectibles. You should never buy any piece of art or collectible unless you actually love it and enjoy it. That's because the reason behind the creation of any artwork, from an oil painting to a Chippendale armoire to a comic book is to speak to someone who will appreciate it. If it isn't at least worth something to you, you may end up stuck with a piece that no one wants, even yourself. That being said, artwork and collectibles can be a good place to invest your money, provided you're in it for the long haul. That's because your investment in a beautiful piece of art or rare stamp is not correlated to stock prices, unlike any investment you make on the stock market. So even if your stocks are down, the worth of your collectibles might be up. Also, individual artists and pieces can perform better than average, meaning your current investment could be worth a great deal more down the road. Of course, it's important to remember that investing in such tangible assets means that your investment is not at all liquid. So you should only spend money on art that you can afford to have tied up, potentially for many years. As with real estate, it's important for you to research any art that you intend to interested in purchasing. Know that what you are buying and make sure you're buying it for the right reasons. Some good news for art and investing newbies. According to Michael Moses, retired New York University business professor and founder of Beautiful Asset Advisors, quote, low-priced art tends to outperform high-priced art as an investment. Number 3, of course, gold and silver. Everybody wants to buy gold and everybody wants to buy silver. This is largely because the price of gold and other precious metals has escalated over the last couple of years. You have to realize that gold is a risky investment and it fluctuates just like individual stocks, sometimes more. That being said, it is a stock market alternative. So if you have a fear of the stock market, then investing in gold coins might be a viable option for you. Todd Tressiter, a financial coach and former hedge fund manager, had this to say. The advantage of gold is it's one of the new few assets with low to negative correlation to stocks, thus providing a valuable portfolio diversifier. Unfortunately for gold investors, the yellow metal has failed to deliver much diversification benefit during recent deflation bear markets. With that said, inflationary bear markets may see valuable downside protection from gold, similar to the role Treasury bonds have enjoyed in recent years. Number 4, wine. Fine wine is not just a delicious accompaniment to your favorite steak dinner. It can also be a valuable investment, provided you go into wine investment with a clear understanding of which vintages and vineyards are the most sought after and what is necessary to protect your investment. You can expect to make a return between 6 and 15% annually. Of course, gaining that clear understanding is no small feat if you are not already a wine enthusiast. That's because it will be necessary to invest in large quantities in order to reap a decent benefit, since 15% on a couple of bottles would hardly make the enterprise worth it, and your investment must be stored in a temperature and humidity controlled environment. Finally, you'll need to keep very detailed records of your purchases to satisfy your future buyers. They will want to know the exact provenance of their beverage. Number 5, peer-to-peer lending. This investment is just what it sounds like. You are lending money to a peer and getting paid the interest rate. It's beneficial for both parties. The borrower will often pay a lower interest rate than they would receive from traditional bank, while the lender's return are often higher than what they could obtain through other investments. Let's say you invest $1,000. Of that $1,000, only $25 to $50 would go to any one borrower. So if that particular borrower defaults, you don't lose your entire investment. This is like buying stock in a mutual fund. If one of the stocks in that mutual fund goes belly up, you still have 99 plus stocks in the fund still making you money. Another great aspect of peer-to-peer lending is the low bar for entry. The minimum investment is only $25 for Lending Club. Which peer-to-peer lender is best? I was curious myself, so I started and looked it up myself. As of now, Prosper versus Lending Club experiments, as of now, have been yielding double-digit returns. Number 6, Treasury notes. Uncle Sam wants you to invest. Putting your money into the U.S. Treasury note is one of the safest of all possible investments because the interest and principal are guaranteed by the full faith and credit of the U.S. government. Of course, as you know, the safer investment, the lower the return. So putting your money into any particular treasury bond may not beat inflation. However, experts claim that 10-year treasury notes, also known as T-notes, are about to see an interest rate increase in 2014, maybe 2016. If you want in on this, remember that T-notes mature anywhere from 2 to 10 years, depending on the date of maturity. The minimum investment is $1,000 to $5,000. Here's how it works. When you invest in a T-note, you purchase a note for some amount below the face value. For instance, you might buy a $1,000 note for $950. You will receive a set amount of interest each year over the life of the T-note. You might collect 3% interest per year, which will be disbursed to you semi-annually, meaning you get a total of $30 per year for a 10-year T-note. And at the end of the term, you will cash the note in for the full $1,000, making your $950 investment worth $1,300 overall. It's important to note, however, that you will owe federal taxes on your interest payments, although you won't have to pay state or municipal taxes. One other big plus for T-notes is the fact that there is a thriving secondary market for them, meaning that they are a pretty liquid investment. Number 7, building a CD ladder. The good old certificate of deposit has always been a remarkable safe place to stash your cash. But while your principal is protected, your interest rate will be pretty low, and you lose some of the interest you've earned if you have to access your money prior to the maturity date. But you can help to maximize your earning potential and keep your money more liquid by creating a CD ladder. Let's say you have $15,000 to invest and are interested in a 5-year time frame. Rather than putting the whole enchilada into a single CD, you could invest in 5 different CDs with increasing maturity dates. For instance, $3,000 invested in a 1-year CD, $3,000 in a 2-year, $3,000 in a 3-year, $3,000 in a 4-year, and $3,000 in a 5-year CD. After your first CD matures, you will get your initial $3,000 investment plus interest back from your first CD, which you can then reinvest in a new 5-year CD, since the rest of the CDs will have moved up the ladder of maturity dates. The benefit of this strategy is that you can take advantage of higher rates when your lowest CD ladder rung matures. And if you find that rates have decreased, you still have money invested in CDs that previously higher rates. Of course, CDs have barely beaten inflation for some time, so even with the CD ladder, investing your money in certificates of deposit is not a good way to grow your wealth. When rates bounce back, however, this could be a good alternative investment. Number 8, investing in a small business. According to another investor, he shared his 5 valuable lessons for starting a business. You can make an equity investment, meaning you have partial ownership of the business and get to share in the profits, or a debt investment, which means you loan money to the business in exchange for interest income and eventual repayment of your stake. Investing in a business debt is less risky, partially because if the company doesn't make it, the creditors are paid before stockholders. Investment in small business is risky, however, because 50% of small businesses fail within the first 5 years, but the increased risk also offers increased opportunities for returns. If you invest in Apple or McDonald's back when they were startups, you would be Scrooge McDuck level wealthy today. And here's an extra, number 9, yourself. You can always do something to improve your skills, your efficiency, your education, your time management, or your prestige within your field. Perhaps there are designations or degrees in your field that could lead you to potential raises or open up new opportunities for you at your job. Alternatively, investing in yourself could mean hiring a coach to help you realize untapped potential. There are many different types of coaches for hire depending on your need. Some coaching examples include life, health, business, career, entrepreneur, and more. Whether it's hiring a coach or spending money on an office so that you no longer have to meet clients at your kitchen table, when you spend money on improving yourself and your career, you open the opportunities for incredible returns on your investment. And these have been the 8 alternatives to investing into the stock market.